Right now, SoundHound AI, trading under the ticker SOUN, is trading at $16.095, and it is having a very rough morning. The stock is down $1.01, a drop of 5.93%. This is happening on heavy volume, with over 10.2 million shares already changing hands just an hour into the trading session. Now, many people watching this stock see it as one thing, a battleground. The common belief, the expectation that has driven so much of the conversation around this company, is that it is a coiled spring, a short squeeze candidate primed to explode. People look at its connection to the artificial intelligence space. They might remember the headlines about NVIDIA once holding a stake, and they see a simple momentum play. But the reality of what is happening today, with the stock bleeding out almost 6%, is far more complex and points to a much deeper conflict. The truth is, the original NVIDIA hype is a story of the past. That stake has been divested. The story today is not about who once liked the company, but about whether the company can currently justify its existence, and more importantly, its staggering valuation. The stock is caught in a violent tug-of-war between a high-growth narrative and a cash-burning reality. This morning's sharp drop isn't just random noise. It is the market expressing severe anxiety ahead of a major binary event. SoundHound AI is scheduled to report its third quarter 2025 earnings on Thursday, November 6th, after the market closes. This is the moment of truth. Everything we are seeing, the high volume, the sharp sell-off, the frantic online discussion, is about investors and traders trying to position themselves for what those numbers will say. This volatility is the signature of SoundHound. You only need to look at its 52-week range, which stretches from a low of 5.16 to a high of 24.98. This is not an investment for the faint of heart. It is a financial battleground in its purest form. So what does SoundHound actually do? Most people might know them from the SoundHound music app, a competitor to Shazam. This is the B2C, or business-to-consumer side, but this is not the story that has institutions and large funds interested. The real business, the one that bulls are betting the farm on, is the B2B, or business-to-business licensing of their Houndify platform. SoundHound's core pitch is that it provides a powerful, independent voice AI solution. Think about it. If you're a car manufacturer, a fast food chain, or a bank, do you really want to build your entire customer voice experience on Google's platform, Amazon's Alexa, or Apple's Siri? Doing so means you hand over your customer data and the customer relationship itself to a tech giant who is also your competitor. SoundHound offers an alternative. They provide the picks and shovels for these companies to build their own branded conversational AI assistants. This is their value proposition. This is why they have been able to sign recent deals, like the one with Telarus to expand their Amelia 7 AI agent to more enterprises, and a new deployment with Apivia Cortage, a French insurer. These partnerships are the tangible evidence bulls point to as proof that the business model is working. But this brings us to the other side of the trade, the short sellers. This is where the story gets incredibly interesting. The expectation is that the high short interest is a sign of an imminent short squeeze. Let's look at the reality of the data. According to the most recent reports from services like Fintel and MarketBeat, the short interest as a percentage of the public float is an enormous 28%. That is not a typo. More than 1 in every 4 shares available for public trading is currently sold short. In absolute numbers, we are talking about over 102 million shares being held by traders betting on a price decline. The days-to-cover ratio, which measures how long it would take all shorts to buy back their shares, is sitting at around 3.8 days. This is the rocket fuel that squeeze-focused traders are looking at. If good news hits, all 102 million of those shares represent future buyers, creating a cascade of forced buying. But a deeper inspection of the data shows a strange contradiction that the simple squeeze narrative misses. While the short interest is high sky, the short borrow fee rate, the interest rate short sellers have to pay to borrow the shares, is currently at a surprisingly low 0.55%. This is a crucial detail. If the stock was truly impossible to find, if short sellers were panicking and scrambling to get their hands on shares, this rate should be in the double or even triple digits.
The fact that it is so low suggests that the shares are readily available to borrow and that the short positions may be stable, long-term positions held by large institutions. These are not nervous retail traders. These are large funds who have a deep-seated bearish thesis and are comfortably sitting on their positions, willing to wait. Their bearish thesis is not just a guess, it is based on the company's fundamentals. The reality that bears see is a valuation that is completely untethered from its financial performance. As of today, Sound Hound Ai has a market capitalization of over $6.5 billion, yet its revenue for the last 12 months was only around $131 million. This gives it a price-to-sales ratio of over 50, which is astronomical. For context, a mature tech company might trade at a PS of 5 to 10. And that's just the revenue side. The company is burning cash at an alarming rate with a net margin of negative 171%. The bear case is simple. This is a 2021-era growth-at-all-costs story that is colliding with the 2025 reality of high interest rates where investors are demanding profitability. The bears are betting that the company's cash burn will become a crisis long before its growth story can ever justify a $6.5 billion valuation. And there is even more to the short-selling story. Retail investors have been pointing to the fails to deliver, or FTD data. Reports from late September showed a massive spike in FTDs, with over 1.6 million shares failing to be delivered on one day alone. FTDs can occur for various clerical reasons, but chronic, high-volume fails can be a red flag for settlement system stress, or, as some retail investors allege, indicative of naked short selling. This data, combined with the fact that over 43% of daily short volume is often happening off-exchange in dark pools, paints a picture of a complex and opaque market. This is an important piece of actionable information for investors. You can find this short interest data on platforms like Fintel and MarketBeat, and the official fails to deliver data is published by the SEC. Understanding these data points is essential to see the full picture, not just the simple squeeze narrative. This is the perfect moment to ask a question I see debated online all the time. What's your take on the low borrow fee despite the high short interest? Is it a sign the shorts are comfortable and confident, or is it the calm before a ferocious storm? This entire conflict is visible on social media platforms like Reddit and X. You will see two completely different polarized camps. On one side, you have the bulls, posting about the new partnerships, the inevitable AI-powered future of drive-thrus, and how the 28% short interest is a guarantee of a squeeze. On the other hand, you have seasoned skeptics and value-focused investors pointing to the $6.5 billion cap versus $131 million in revenue. They are the ones saying this is a meme stock, a classic bubble, and that a company like Google or Apple could eat their lunch with a single software update if they ever decided to truly compete in the independent B2B voice space. This brings me to my next question for you, and I really want to know what you think. Comment below. Do you believe SoundHound's independence is a real, durable, competitive moat, or do you think the tech giants will ultimately dominate this space, making SoundHound's entire business model obsolete? Ultimately, all of this tension, the bulls, the bears, the valuation, the short interest, all of it comes to a head on November 6th with the earnings report. This is the catalyst that will prove one side right and one side catastrophically wrong. There are two likely scenarios. In the bull scenario, SoundHound doesn't just beat revenue estimates, it has to crush them. It has to show that its revenue growth is accelerating, not just meeting expectations. More importantly, it must show that its cash burn is slowing and that it has a clear path to profitability. If they announce another major partnership on top of that, the 28% short interest will act like gasoline on a fire. The 102 million shorted shares will represent a stampede of forced buyers, and the stock could aggressively retest its 52-week high of 24.98. Then, there's the bear scenario. In this reality, SoundHound meets revenue, or even worse, misses. The more critical number will be forward guidance. If they guide for slowing growth or reveal that their cash burn is accelerating, it validates every single bear thesis. It proves that the partnerships are not scaling fast enough to cover the company's massive costs. If this happens, the shorts are proven right. The The $16 price we're seeing today will look incredibly expensive, and the floor could fall out as investors race for the exits. We could see the stock heading back towards single digits, and those analyst price targets that are below the current price will look prophetic. So as we watch SoundHound AI, ticker SOUN, slide nearly 6% today to $16.095, we are not just watching a stock go down, we are watching the physical manifestation of market anxiety. The expectation, the common story, is that this is a simple AI stock in a short squeeze. The reality is that this is a deeply unprofitable, high-growth, high-risk company balanced on a knife's edge. It is a war between a new-age B2B technology narrative and an old-school fundamental valuation. And on November 6th, this war will have its most decisive battle yet.